The money in your bank account isn't actually there. This isn't a metaphor, and it's certainly not a conspiracy theory. If every customer walked into their bank tomorrow morning to withdraw their cash at the same time, the system would collapse within hours. That's because the money is not physically present. This isn't a glitch or a system error, it is the intentional design of the global financial system. It is a trick so old and so deeply entrenched that we have come to accept it as normal. This is called fractional reserve banking. It is the silent engine behind global debt, inflation, and that famous illusion of wealth. Once you understand how this system works, you will realize that money is built on promises that can never truly be kept. It all began in medieval Europe. At that time, money meant gold and silver. But carrying bags of gold was dangerous. People began depositing their valuables with goldsmiths, who had secure vaults. In exchange, the goldsmith would issue a receipt, a promise stating, "I will give the gold to whoever brings this note." Soon, people began trading these receipts instead of the gold itself. The goldsmiths noticed something: almost nobody came to claim their gold at the same time. Only 1 or 2 out of 100 customers would stop by. So, the goldsmiths decided to pull a fast one. They issued more receipts than the gold they actually held. If there were 1,000 gold coins in the vault, they distributed 2,000 gold coins worth of receipts and lent them out at interest. They were profiting from gold that didn't exist. As long as everyone didn't show up at the door at once, no one noticed a thing. This is how money created out of thin air was born. Today, the system is much more abstract, but the foundations remain the same. When you deposit $1,000 in the bank, you imagine that money is sitting in the vault waiting for you. In the past, banks would keep 10% of that and lend the rest as credit. That credit would circulate and eventually be deposited in another bank, which would then lend out 90% of it. In the end, your $1,000 in the bank would become $10,000 in the economy. But in reality, only the first 1,000 was real, the rest were just promises of debt. Hold on tight, because it gets worse. Today, in countries like the USA, this ratio has dropped to 0. This means banks aren't even required to hold a mandatory reserve. Banks no longer lend out the money you deposit, they create loans first, and those loans automatically generate new deposits, money. When you take out a home loan, the bank doesn't pull cash out of a vault, it simply types new numbers onto a computer screen. The moment you say, "I will pay it back," that money is conjured out of thin air. More than 90% of the money circulating in the market is not money printed by the state, but these ghost monies created by banks through debt. This design has unavoidable consequences: inflation. As banks constantly multiply the same money and turn it into credit, the value of money drops. Prices rise not just because of supply and demand, but because the money is being diluted. Perpetual debt. Since money enters the system as a loan, the total amount that needs to be repaid globally is always more than the money that actually exists, because of interest. This means someone, somewhere, must always go bankrupt, default, or take on even more debt. Concentration of power. Banks collect interest on money they never truly had. This system allows governments to finance wars and crises without raising taxes. While the wealthy grow even richer as inflation drives up the price of properties and stocks. Wage earners watch their purchasing power melt away every year. So, what stops banks from creating infinite money? These reins are no longer held by parliaments elected by the people, but in the city of Basel, Switzerland, at the Bank for International Settlements, BIS, the central bank of central banks. There, appointed technocrats decide how much risk banks can take. In other words, the rules that determine the value of the money in your wallet are written behind closed doors by people you have never met. The uncomfortable truth is this: this system cannot afford for you to be debt-free. If everyone paid off their debts tomorrow, the money supply would collapse and the economy would grind to a halt. You are both the fuel and the collateral of this machine. History has taught us this. The Great Depression of 1929, the 2008 crisis, they all exploded because more promises, debt, were given than reality could support. When confidence shakes, that house of cards collapses. But each time, they save the system and continue the game, because modern economics cannot function without this illusion. So, what should you do? Money is not wealth, the numbers on the screen are not wealth. Real wealth is land. Resources, skills, knowledge, and independence. Debt is not neutral. Debt is a deception designed to make you a slave to the system. Inflation is not an accident, it is the method of silently taking away your labor. Next time you look at your bank account, remember, most of those numbers exist only on paper and were not designed for your freedom. If you understand this trick, you can begin to protect yourself. If you don't, you remain just another pawn in a game where the house always wins.